Let's go back. Let's go back. It's AP Macro, Unit 4, Financial Sector. It's April 4th, which for some of you is Easter. If it is, happy Easter. And if it's not, happy Sunday. Happy April 4th. A reminder that we're being recorded. So if you don't want anybody to know that you're an econ nerd like I am, then you should change your name so they cannot see your name when they see this recording. Don't forget that you can connect with Fiveable on Twitter, Instagram, and YouTube. And of course, our website and my favorite place, our Discord. Today, we are covering Unit 4. We will meet twice this week, today and again on the 9th, which I think is Friday night. But now that I think about it, 5, 6, 7, 8, 9, that is Friday night. I will see you guys then for Unit 5. I was mentioning that we are about halfway through our CRAMs after today. So we're getting there. We're getting close to the AP exam. I don't know how many of you are actually taking it on May 10th. I know my students are taking it at the second offering, the digital one. So we have a couple of extra built-in weeks this year for some of you, and that's pretty exciting. Okay, today we're going to cover financial assets, nominal versus real interest rates. We're going to talk all about money, and money is super exciting because either we have money or we want money, but either way, money is super important in our world, as much as we'd like to say that it's not. We're going to talk about the banking system, and we're going to talk about how banks literally create money out of thin air, which was by far the most interesting thing I ever learned in econ. It will just blow your mind. Maybe not as much as it blew my mind because we've already talked about the regular multiplier before, but when I learned it, it was the first multiplier I learned, so it was just crazy. We're going to talk about the money market, monetary policy, which is enacted by the Federal Reserve Bank, and then the loanable funds market. Notice there's two markets on that list. Two markets means two more sets of graphs, which will look almost like every other market graph we have looked at, but like the others, will have different labels on the X and Y axis. So it's something new, but not too new and not too difficult. All right, so let's start with financial assets. Assets are things that you have that are worth something. The most basic one would be money. And we have money because it makes it possible for us to compare the worth of goods and services. So way back in the day when there was no money, people used a system of barter or trade. And it was difficult to tell what something was worth in relationship to something else unless that was physically what you were trading. But money allows us to see, okay, this book is $10. This PlayStation is $499. Now I can compare the worth of those two goods based on their actual money price, okay? Liquidity is how fast you can turn whatever assets you have into cash. So assets don't have to be money. Money is a basic asset, but like a house is an asset, a car, jewelry, paintings, and basically anything you own is an asset. And how quickly you can make it be cash is refers to how liquid it is. You might have seen a business going out of sale. Unfortunately, I think we're seeing like a lot of those right now because of COVID. And you see they're having a liquidation sale. And when I was a kid, I was like, what are they going to turn like all of the suits in the suit factory into liquid? What's a liquidation sale? And it was them taking their assets, what they had, which was their inventory, and selling it so they would be more liquid. They would have more cash. Okay. So cash and coin are obviously the most liquid because they're already cash. The longer it takes for you to take an asset and turn it into cash, the less liquid the asset is. So my house, for example, is an asset. But I can't just like go and spend the money in my house today. I'd have to like put it on the market. People would have to come look at it. Of course, right now things are selling in like 2 days. So I could probably sell it pretty quickly, but we have to go through escrow and blah, 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 blah. I wouldn't have cash in my hand for like 6 to 8 weeks, maybe even longer. So that makes it a lot less liquid than cash that is sitting in my bank account. Other kinds of financial assets include stocks and bonds. Bonds are super important today because we're going to be talking about the Fed. But a bond is essentially when you loan money to a business or the government, and they say they are going to pay back your money in a certain amount of time with a certain interest rate. So we're going to talk a lot today about government bonds. You might have had a grandma that like bought you a savings bond one year for your birthday, and you're like, what am I supposed to do with this piece of paper? They're not really great in small amounts like that, but in the large scale purchases, especially when you buy and sell bonds that were already bought or sold, it can make you a bunch of money. And we're going to talk about that later in the presentation. But it's important also to remember that bonds are also called securities. So when you hear somebody talk about securities, you might have heard of the Securities and Exchange Commission, the SEC. They're talking about bonds. Okay, so the government needs money. We loan the government money as citizens. They pay us back that money plus interest 10, 15, 20 years from now. And that's what a bond is. Stocks are another asset. And that's when you get ownership in a company. It started way, way back in the day with the joint stock companies. If you took AP World, you remember learning about the British East India Company and the Dutch East India Company, and people would put money in and they would have partial ownership of it. Today, you can, of course, buy and sell stocks a lot easier than you could in the olden days with apps like Robinhood and things like that. But you're buying a piece of a company, essentially. Now, if you have one share or even 1,000 shares or even 10,000 shares of a company, that does not mean you get to make decisions like hiring and firing or anything like that, but you do get to share in the profit of the company. Risk. Risk is this thing that you have to take if you want to get anything. The less risky something is, the less you're going to get out of it. And that goes right hand in hand with the rate of return. So for example, if I put my money in the bank, there's almost no risk because unless I have more than $400,000 in there, it's insured by the government, FDIC insurance. And so even if the bank collapses, I will get my money. So no risk. But also in my checking account, I have no rate of return. I'm getting no interest. So maybe you have your money in a savings account, which is also FDIC insured. Super exciting to get interest, but the interest that you get is like 0.005%, and that's not an exciting amount of interest. So the less risk you put out, the less you get in return. Now, if you want to go all the way like the other way and you want to talk about buying into the stock market or investing in somebody's business, that's a heck of a lot riskier. You could make a whole bunch of money, but you could like also lose all of your money. But the rate of return is going to be so much greater in that kind of investment than it is in these safer investments. Okay, those are things you should remember for the rest of your life as you invest all of your monies. Okay, bonds and interest rates. So remember I told you that you can actually make quite a bit of money on the bond market. And you do this by buying and selling previously issued bonds. So first you need to understand that the price of those bonds is inversely related to the interest rate on them. And this is a little confusing at first, so bear with me. So imagine you bought, let's imagine you bought some bonds like 5 years ago. And when you bought those bonds, they had a fixed interest rate of 5%, which means the government was going to pay you 5% on however much money you lent them. And that was not going to change. Now imagine we're here today and interest rates are lower, which by the way, they are lower now than they were 5 years ago. So this is a pretty accurate example. Now, if somebody wanted to lend money to the government's paying out a lower rate, maybe only 2 or 3%. That makes your bonds that are paying out 5% super valuable. And then you can actually sell them and make some money off of them. On the flip side, if you bought bonds at a 5% interest rate and the interest rate is now 8 or 9% that people can get from the government, then your bonds are worth less because your interest rate is lower than that, which is actually prevailing in the economy at the time. So that's important to know. It's also important to know that if you keep all your money in cash money, which some people do because they're like horribly afraid of banks and think they're going to get swindled out of their money here, there, and everywhere, there is a cost to that. It doesn't seem like there's a cost. You know, people used to stick their money like under their mattress. Well, what's the cost of that? If my money is there, it's not making any interest, not even the little itty bitty amount of interest it could make in a savings account. And therefore, because the economy is moving forward and there's inflation, my money is actually like losing value. And so the opportunity cost of keeping my cash in cash is all that interest I could have earned from a CD, which is or mutual funds or stocks or bonds or straight up investment. Okay. You've heard the phrase "it takes money to make money," and they're not crazy. They're not kidding when they say that. But it's also super important to remember that the bigger the risk you're willing to take, the greater the return could be. You could also lose your shirt. All right. Nominal and real interest rates. So we talked a little bit about nominal and real last week, but nominal is just like what it is. Here's the interest rate. It's 5% straight up. It's not adjusted for inflation. There's not any weird calculations. That just is what it is. The real interest rate is, however, adjusted for inflation. So this is taking into account what else is going on in the economy. So I put some examples here. If the nominal interest rate, which is just the regular interest rate, is 4%, and there's 2% inflation, then you're not really making 4% on your money. You're really only making 2% because you're taking the nominal interest rate and subtracting inflation from it. I should also take this moment to note, if somebody just says interest rate, they're talking about the nominal interest rate. They're not going to be talking about real unless they specify real. So another example here is if the nominal interest rate is 6% and inflation is negative 2%, which is very unlikely, but bear with me anyway. We'll take our 6% and we will subtract our negative 2%. Remember, subtracting a negative just makes a positive. So 6 plus 2, that would mean an 8% real interest rate. That's what you're really earning. That's how I like to remember it. Now, banks expect there will be inflation, but sometimes they don't know how much inflation there will be, and there's more than what they expected. So, for example, they're putting out all these loans and they're making interest rates, and they're like, well, I think there's going to be about 2% inflation. They said everything, everybody's happy. But then there's like 5% inflation, which sounds like it's bad for you. But if you are a debtor, which means you owe money to somebody, unexpected inflation is actually really good for you because now you are paying back whatever you borrowed with money that is worth less than the money that you borrowed. If you're a lender, unexpected inflation is bad. It's really important to note that the unexpected part is crucial because the banks expect inflation. So it's not just inflation is bad for lenders, unexpected inflation, like if they didn't quite figure out how much inflation there would be. All right. Oh, a practice question. Yay. All right. Let's open up our poll so we can look at this practice question. Which of these is adjusted for the inflation rate? Which of these is adjusted for the inflation rate? I'll give you guys a second with that. Is it the nominal interest rate, GDP, the real interest rate, or wages? Which one of those things is adjusted for the inflation rate? And fantastic. We've got some correct answers coming in right here. Mostly correct, because our answer is a C, the real interest rate. Okay, anytime you see real, it's adjusted for inflation. So you could have real interest rate. You could also have real GDP. Remember, we talked about nominal and real GDP. But also remember, I said if it doesn't specify real, they mean nominal. Okay, so the real interest rate, real GDP, real anything in macroeconomics means it's adjusted for inflation. All right, I think we have another question. Dun, dun, dun. Here we go. Alexander, that's my son. All of these questions are named after my children and friends. Alexander took a 6% one-year fixed rate loan to buy a new motorcycle. Side note, I would never let Alexander buy a motorcycle. He is expected to pay a real interest rate of 4%. If at the end of the year, Alexander only paid a 3% real interest rate, which of the following is true? Okay, so you got to take out like all the unimportant information here, by the way, which is the motorcycle and the person and all that stuff. And you need to look at those numbers. He thought he was going to pay a real interest rate of 4% on his 6% loan, but he actually paid a real interest rate of 3%. So if you remember, we did some subtracting. You take your actual interest rate and you subtract the inflation rate, which should help you answer that question because only one of the answers refers to the inflation rate. So our answer is, of course, D. So Alexander took a 6% one-year fixed rate loan. The inflation rate was 3%, which is our answer. 6 minus 3 equals 3. That means his real interest rate was 3%. All right. They like to ask questions like this, by the way, on the AP exam. Okay. Now we're going to talk about money. Yay, money. Okay, so money is divided into 3 categories. M1 is cash and coin. Demand deposits. That means the money you put into a regular checking account. Traveler's checks. I thought about whether or not I should list traveler's checks on here because it's definitely part of M1, but it is like also definitely not really much of a thing anymore. So you might be sitting there and wondering what the heck a traveler's check is. So in the olden days, before we had debit cards and fun stuff like that, people didn't always want to carry cash with them when they traveled places, especially to foreign countries, because it seemed dangerous. So they put their money into traveler's checks, which were a little bit more secure. I've never actually seen a traveler's check because they went out of fashion like many years ago, but you should remember they're part of M1 because the College Board still remembers that they're part of M1, even though nobody really uses them anymore. And any other checkable deposits. So anything you can write a check against is a demand deposit. It's all part of M1. M2, here's a tricky part. M2 includes everything in M1 plus, okay, so all of M1 is part of M2, plus savings deposits, any certificates of deposit, those are CDs, we talked about those before, money market funds, anything like that, anything under $100,000. M3, which I didn't make a pretty box for, includes all of M1, all of M2, right? And then the same things as M2, but in larger scale, so over $100,000. And you should also know MO or MB, which talks about the current currency in circulation and in bank reserve. So that's like how much money there is altogether. All of the M's. Every time I talk about this, it reminds me of bananas and pajamas, and they have B1 and B2. But now we have M1 and M2. So here is a practice question for you. Thinking about M1, thinking about M2, thinking about liquidity, which we started with today. We have a list here of financial assets, and I want you to put them in order from the most liquid to the least liquid. So we're talking about cash, a house, stocks, savings account. We're going to put them in order from the most liquid, the thing that is most like cash, to the least liquid, which is the thing that is least like cash. All right. And we're doing pretty well there. So no surprise, cash is most like cash. So our answer definitely has to begin with cash. So we know it's either A or B. And the house is the least liquid thing there. So our answer is B. Good job, my friends. All right. I was super big on practice questions in this round, which is good because you guys are going to be taking these AP tests soon. And these are all based on real AP questions. So these are all things you could actually see. All right, so Rachel, that's my best friend. She transferred $1,000 from her savings account to her checking account. How will M1 and M2 change? So first you have to think savings account. Is that M1 or M2? And hopefully you guys remember that the savings account is in M2. So she's taking the money from that account and she's putting it in her checking account. So hopefully you also remember that M2 includes M1. Haha. That might trip you guys up a little bit. So she had $1,000. She took it from her savings account to her checking account. So when it's in her savings account, it is part of um, M2, which includes M1. And then she moves it from her savings account to M1. I said that out loud so many times that I've confused myself. Do you guys ever do that? Maybe it's because it's Sunday. Okay, so it was in M2, which is a savings account, which includes M1. She takes it out of M2, so M2 is definitely going to decrease. And I see that our answers are pretty split here between A and D, right? So our M2 is definitely going to decrease, and our M1 is going to increase. So I definitely put that the answer was D, but the answer is definitely A. So don't get confused by me when I publish these results, because you're right. M1 is going to go up. M2 is going to go down. People that put D, if we had gone in the other direction, then you would have one that stays the same. But because we went from savings to the checking account, that's why they're both going to change. And the College Board likes to be tricky with you. So remember that. Okay, so we talked about the different categories of money, but like, what is money? So money is something that you could use to buy something. It's a means of payment. So I'm going to tell you something super depressing right now. Normally I would show you a dollar bill, but I do not have the capability to show you my slides and my face at the same time. So imagine you have a dollar bill, or if you have any kind of cash money, I want you to look at that money right now and ask yourself, is this money worth how much it says it's worth? Keeping in mind that like a $1 bill and a $5 bill and a $20 bill and a $100 bill are all like essentially the same thing. So is that $100 bill worth more than the $1 bill? And you'll say, yeah, of course, it's $100, not $1. But the actual bill is not. So the $100 bill is worth $100 because the Federal Reserve Bank, it's printed on the money, and the Treasury and the United States of America says that that bill is worth $100. And that makes it fiat money, which is money with no intrinsic value. It has the value it has because they tell us it has that value. On the other hand, you have commodity money, which is how everything started when money started. People would actually use like gold or silver coins, and they actually had intrinsic worth, which meant it was actually worth something in and of itself, not because somebody told you it was worth something. So gold, silver, oil, salt, tobacco, those kind of things are commodity money. So all that money that you have, or if you're like me, all that money you don't have, is only worth what it's worth because our government says that. And for some people, that's really scary, but it is the reality. Also, in the olden days, money was backed by gold or silver, meaning that if there was money in the economy somewhere at like Fort Knox or whatever, there was a whole mess of gold or silver to back up that money. And that is not the case anymore. Our money has not been for a long time backed by anything but the word of our government. Okay, so money, now that I've scared you all, money has three functions. The first function is a medium of exchange. I talked about bartering earlier, but I want you to like think about bartering in more detail. Like if I wanted a fish and you had a cow, I'm sorry, if I wanted a fish and I had a cow and you wanted some cow and had a fish and we wanted to trade, a fish and a cow aren't really like an even trade. But you can't really like subdivide your cow. Like if you cut off his leg to give me the leg in exchange for the fish, then the rest of your cow would like die. And then it wouldn't be worth anything. So that was really annoying. And it was also hard to like carry a cow. And so people started to carry money. So that has to do with like the medium of exchange because it's easier to exchange money than goods. You don't have to look for somebody who wants what you have. You just need money and you can buy whatever you want. Store of value, it holds its value for the most part, minus inflation. Unlike my cow that now only has 3 legs, which will not keep its value because it will die and now be worth nothing. And then our unit of account, which has to do with like subdividing things and knowing how much something costs. You go in, it's like, okay, it's $10, and you can give somebody a $10 bill, or you can give them a $20 bill, and they can give you $10 back, and all these fun things that you couldn't do if you were exchanging a cow for a fish. Okay. So, things you really need to know, key terms for the money supply. Depository institutions. That sounds scary. It's not. It's like a bank. Commercial banks like Chase, Wells Fargo, Bank of America, wherever it is you may bank. They are people that accept financial, they accept monetary deposits from consumers. The Federal Reserve Bank, we're going to talk about a little bit later, is not really a depository institution because you and I cannot bank there. Okay, so these are places where people can bank. Fractional reserve banking is the idea that you put $100 in the bank and the bank doesn't actually have to keep all that money in the vault. This part of the lesson is scary too. They can use some of that money to lend out. And that is what fractional reserve banking is. You only have to keep a fraction in reserves. Required reserves is the amount that you actually have to keep in the bank, in the vault, according to the Federal Reserve Bank. I oftentimes use 10% as the example of what the reserve requirement might be, or the required reserve ratio down there at the bottom, because it's like an easy number. But just to scare you guys a little bit right now, the current required reserve ratio because of COVID is 0. We're going to talk a lot about this in the next few minutes, but essentially that means that if you put money in the bank can lend out all of your money to somebody else and does not have to keep any of it on reserve. Excess reserves is the money that the bank keeps and holds on to in cash or in their vault that they don't have to. So if the reserve requirement is 10%, but the bank holds 20% in reserves, then 10% is the required reserves, and the other 10% are excess reserves. And before you freak out about the fact that banks don't have to hold any money in reserves right now, I'll tell you that they like to hold money in reserves because they are penny pinchers. Okay, so dun, 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 the money multiplier. Yay. Okay, so we've talked about the spending multiplier and the tax multiplier. So you know that a small change can have a greater change, and that's the money multiplier. The money multiplier is how banks can create money out of thin air. So right in front of you, you see the formula for the money multiplier. You can also just call it the reciprocal of the reserve ratio, but maybe you hated math and you don't remember that the reciprocal is 1 over whatever the number is. So you can look at it either way. But let's imagine that I put $1,000 in the bank, okay? And we're also going to imagine that the reserve ratio is 10%. So 1 over 10%, or 1 over 0.1, equals 10. So if I put $1,000 in the bank, it can actually have a $10,000 effect in the economy, because the banks are literally going to create money out of thin air. Yikes. Okay, so I put my $1,000 in. They're all happy. And then Rose goes to the bank and Rose says, I would like to take out a loan for $900. And they're like, oh, well, we can definitely give you that loan. And she takes out the loan and she goes to another bank and she puts that money in the bank. And when she puts the money in the bank, of the $900, they will have to hold on to $90, right? Because that is the reserve requirement. And then they're going to lend out the other $810. So now Beatrice goes to the bank and she borrows $810. She puts that in her bank. They keep $81. They lend out the rest, et cetera, et cetera, et cetera, all the way till you get to the point where they have created so much money out of my $1,000 deposit. So the money multiplier is great, but is often overstated because some people aren't going to turn around and take whatever money they borrowed and put it in a bank. They might hold it as cash, right? And it also doesn't take into account that the banks do like to hold on to some excess reserves because they like to make sure they have some liquidity. So with that, we're going to answer another practice question. And I'm going to open the poll for practice question numero 5. Why might the money multiplier be overstated? This is essentially, did you just listen to what I said? A, it might not take into account excess reserves held by banks. B, it does not take into account money held as cash. C, both A and B. D, neither A nor B. I like some of our answers coming in. So, and nobody's 100% wrong yet. You just might not be as right as you could be. So why is that money multiplier overstated? A is definitely correct that they do not take into account excess reserves, but B is also correct because it does not take into account money held as cash. Money can't be multiplied unless you put it into the bank. So good job, guys. The answer is C, both A and B. All right. Oh, bank balance sheets. I don't think any of my students are here today, but I wish they were because I was just reading up about how the College Board thinks that this is somewhere where students aren't as successful as they can be. So listen up here about bank balance sheets. A bank balance sheet is exactly what it sounds like. It's a sheet where you balance things. And when you balance things, that means that they have to be the same on the left and the right. I'm sure you've balanced equations at some point in algebra or chemistry, or maybe you sat on a teeter-totter with somebody, or maybe, I don't know, you weighed something and it was like the scales of justice, right? Where you're trying to balance it, okay? So on the left side, we have our assets. And on the right side, we have our liabilities. So we already know assets is like stuff that you have that's worth something, right? Liability is stuff that you owe somebody. Okay. So the assets and the liabilities on your bank balance sheet have to balance or be equal. On this slide, I've listed the words you might see on either side. There are a couple other terms that are used here and there, especially if you go into econ in college and get a degree in it, and it gets way more convoluted and complicated. But in terms of the College Board, these are the words you're going to see. Okay, under assets, you might see required reserves, excess reserves, and loans. And we should at this point know what those things are. So required reserves is the amount they have to keep, excess reserves is the extra that they keep, and loans is what they do with all the rest of the money. So on the right-hand side, we have liabilities. The first one is demand deposits. Why is that a liability? Well, if I put $1,000 in the bank, does the bank really own that money? It's not an asset for them, but it's my money. So if I go back, they have to give it back to me. And that is what they mean by demand deposits, because I can demand for them to give my deposit back. And that's why it's a liability. And then you also have owner's equity, which we're not going to go into depth about, but just know that it belongs on the liability side. Okay. So on the next slide, I put some actual numbers in here so we could play around with it and we could look at it a little bit. So this is the kind of problem they might give you. They might ask you to calculate the required reserve ratio by looking at these numbers. So we see here in front of us that our liabilities are $10,000 in demand deposits. That means $10,000 has been put into our bank. And we have to keep, according to the left side, $1,000 in required reserves. So that's my required reserves. 1,000 divided by 10,000 is, anybody? We have to do math now. Don't make us do math on a Sunday. Not in econ. Econ's social science. This is why I love econ, because it has math and historical things in it. But 1,000 over 10,000 is 0.1, or a 10% reserve requirement. And so that would be the answer. Okay. Number 2, it asks, what is the money multiplier? Well, if my reserve requirement is 0.1, 1 over 0.1 equals 10. So my money multiplier is 10. And then this says, how much can the bank expand the money supply? And this is a tricky question. Okay, so I've put in $10,000, which was in the money supply, yeah? Well, not I. Somebody put in $10,000. And if the money multiplier is 10, 10,000 times 10, $100,000. Except $10,000 was already there and all that fun stuff. Notice this bank here has excess reserves. That's $8,000. That means that's money they could lend out. The loans is $1,000. That's money they've already lent out. Notice that 1,000 plus 8,000 plus 1,000 equals 10,000. And on the other side, we have 10,000. They have to balance. Yes, they have to balance. So sometimes they'll give you a problem like this, and then they'll tell you that somebody else puts in a deposit and you'll have to add it. So if somebody had to put in money, you would add it on the liability side. That would increase the demand deposits, which of course means you're going to have to put something on the left side for the assets. So it would be excess reserves, some in required reserves, some in excess reserves, unless they tell you that they lent it out. So these are questions they might ask you in free response format, especially on the AP exam. Okay. All right, the demand for money. Gosh, that looks like every other demand curve we've looked at over the last several weeks. No surprise there. But please pay attention to how our axes are labeled. The y-axis is interest rate. It just says interest rate. So of course they're referring to the nominal interest rate. On the x-axis, we have the quantity of money. I'll get back to you in a second on that one, Rose. I want to get through as much of this. Oh, let's see. Let's see if we can go back. Okay, how much can the bank expand the money supply? So the money multiplier is 10. So you multiply the money multiplier by the demand deposits. So 10 times 10,000 is 100,000. But sometimes they'll try and trick you. And they'll say something like, what is something they might say? You have to read the question very carefully each time they ask it, because they might ask it in such a way that you should not take into account the original money that was deposited. So like 10,000 times 10 is 100,000, but $10,000 was like definitely already in the money supply. So now they're really only expanding the money supply by like 90,000. Sorry, I can't do my math today, by 90,000. So, but sometimes they want you to include that amount. So you really have to read their questions very carefully to know what they're asking for at the moment. But don't forget that we're going to have 2 whole sessions where we just do free response questions. So we're going to have so much practice with that. You guys will be golden. And if you wanted to practice free response questions on your own, literally the best advice I've ever given anybody for AP Macro, and I give it every year, is to go back through all of those released questions that the College Board has on their website, because there's not a lot of variety they have in those free response questions. There's only so many things they can ask. And if you can do all of the released questions from like the last 10 years and and you feel confident in them, not like memorize them, but understand why you're doing what you're doing, then you'll be able to answer any question they might throw at you. They might change the numbers. They might say increase instead of decrease here and there, stuff like that on the questions. But they basically stick to the same format. And so that's a really great way to study for that. And that's part of what we're going to do when we have our free response sessions. Okay, so back to our demand for money. It looks like every other demand curve we've looked at, there's an inverse relationship between the nominal interest rate and the quantity of money people want to hold. Change in the quantity demanded of money. So remember, we always talk about quantity demanded. We're moving along the curve. So like from point A to B or B to C, for example. But you can also shift the whole curve, which would be a change in the demand for money. Okay, so along the curve is a change in quantity demanded. Change in demand would shift the whole curve. And that could be caused by a change in the price level, a change in income, or transaction costs for stocks and bonds. So a change in the price level. So if the price level goes up, now I need more money to buy stuff. So now I'm definitely demanding more money. So my curve is going to move up and to the right. If my income goes up, real GDP goes up, again, I'm going to demand more money. Transaction costs is like those really annoying fees that you pay when you sell a stock or bond. And those can also influence the demand for money, but not as readily as the other two. But you should definitely know that's one of the third things that can shift the curve. Okay, on the flip side, we have the supply for money, which does not look like every supply curve we looked at, but it does look a lot like the LRAS curve because it is straight up and down. And that's because the money supply is totally independent of the interest rate. The interest rate does not determine how much money we have in the money supply. The Fed can influence how much money we have in the money supply. And the Fed, the Federal Reserve Bank here in the United States, is our central bank. Now, I talk about the Fed a lot in the United States, but this is true in like any other country. There is an economy, there is a central bank. It just probably has a different name. And that central bank, those are the people that can influence the money supply. And they can do that by using monetary policy, which is what we're about to talk about. If they try to expand the money supply, it will move that curve to the right. And if they're trying to lower the money supply, it will move that curve to the left. All right. Equilibrium is when the two curves come together. No surprise there. We have experienced equilibrium several times together. Disequilibrium can happen, of course. It can create shortages and or surpluses in our money supply. If we increased consumer spending, for example, that would take that demand curve and it would shift it up and to the right. Now, that would not change the quantities of money, right? Because the money supply can only be affected by the Federal Reserve Bank, but it would change the interest rate. So I highly suggest you take a look at this later and see how the interest rate is affected by movements of the curves. All right. Dun, dun, dun. Investment demand. Investment demand goes hand in hand with the interest rate changing. So when the money market changes, it also is going to affect the demand for investment. And this is the desired quantity of investment spending by firms across the economy. And the lower, there's an inverse relationship between the nominal interest rate and the quantity of investment demanded. So the lower the interest rate, the more investment they're going to demand. And the higher the interest rate, the less investment they're going to demand. And we're going to see in a few minutes, we're going to look at how each graph affects the other graph. And this changes when there is monetary policy. So you see a money market graph right in front of us. And notice in that graph, our money supply has shifted to the right because that means the Fed will have done some kind of expansionary monetary policy. And when it shifts to the right, that lowers our interest rate. That lower interest rate is going to increase the demand for money. So the graph in the middle is the money market graph, and the graph all the way to the right is the investment demand graph. But we will look at those in more detail in just a minute. So what is monetary policy? Okay, these are all the things that our central bank can do. They do this to achieve certain goals they have. They have a whole bunch of goals, and they actually do more than stabilize the money supply, but that's really what we're going to talk about today. They want to stabilize prices and all of those things. They want to make sure that we are at full employment, that our economy is working to the best our economy can work. So there's a bunch of different things they can do. And when they do these things, it can influence aggregate demand. It can influence our output. It can influence the price level, interest rates, all of those good things. So I'm going to bring something to your attention right now. I'm going to guess that you guys have looked at the Fiveable Study Guide, which 98% of it is absolutely 100% fantastic, and you should look at it. But it does mention in there that the federal funds rate is monetary policy. And I want to tell you right now why it's not really monetary policy. So the federal funds rate is the rate that banks charge each other for overnight loans. So let's say Chase Bank is like, dang, I'm $100 short. Bank of America, can I borrow $100 for the night until somebody comes and deposits money into the bank in the morning? And Bank of America goes, yes, you can. I'm going to charge you the federal funds rate. Okay, it's not specifically set by the Federal Reserve Bank, but the Federal Reserve Bank does stuff to kind of like hit a target rate. They're like, well, we'll mess with this or we'll mess with that. So hopefully the banks charge each other approximately this rate. So in that sense, it's like, I don't know, the step child of the monetary policy. It's not exactly monetary policy. So when the College Board asks you about monetary policy, the federal funds rate can be influenced by it, but in itself is not monetary policy. Okay. And when the Federal Reserve Bank changes interest rates, which we're going to talk about in a second, they only change one interest rate, but it affects all of the other interest rates. But they're only responsible for one. So this is basically what the Fed can do to affect the economy. If you remember last week, we talked about what the government can do to affect the economy. That was called fiscal policy. I remember that monetary policy is done by the bank because banks are where you put money, and fiscal policy belongs to the government because it just sounds way more highfalutin. Just like fiscal policy, though, there are lags when you implement these things and to effectiveness. So they're not like 100% perfect, but they're pretty awesome, if you ask me. I have, by the way, a huge love for the Federal Reserve Bank. So here we go. So here are the three things that the Federal Reserve Bank can do. And if you don't trust my knowledge of the Federal Reserve Bank, I'll tell you right now that I was on the Education Advisory Committee for the Federal Reserve Bank of San Francisco. And there's a lot of cool history about the Federal Reserve Bank that I highly suggest you look into. But is not actually necessary for the AP exam. So we won't talk about that too much. But know that the Fed and I, we're close, we're buddies. I wish they would let me know what they were doing with interest rates before they told the rest of the country, but that's a whole other story. So the discount rate is the interest rate that the Federal Reserve Bank does have control over. And that is how much they charge commercial banks like Chase, Wells Fargo, Bank of America, whatever, how much they charge them to borrow money from the Fed. It is the only interest rate that they directly control. Now, when that rate goes up, it tends to change other interest rates. So you heard a lot of people recently talking about mortgage rates. Mortgage rates are all-time low, blah, 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 blah. The Federal Reserve Bank didn't set the mortgage rates, but as the Federal Reserve Bank lowered the discount rate, it's, by the way, very low right now because we're really trying to save our economy. The banks, in turn, now that they don't have to pay as much when they borrow money, don't charge as much when you borrow money. Okay, but the discount rate is the only one that the Federal Reserve Bank has actual control over. The other ones are influenced by it. We talked about the reserve ratio earlier. It's the portion of demand deposits that the bank has to hold in cash. It is currently 0, which is really scary. That means they don't have to hold any cash, but a lot of banks are holding excess reserves, which is, of course, any amount they hold over and above the reserve ratio. The reserve ratio does not get changed very often. It is not a common tool in monetary policy, but one that they do have. And I used to talk about how it never gets changed, and then they lowered it to 0. And I was like, okay, it sometimes gets changed, but not so much. The discount rate gets changed more often than the reserve ratio, but not on the daily. Okay. Usually they wouldn't change it more than once a quarter, and oftentimes it stays the same for several quarters in a row. Now, open market operations, that happens all the time, and none of us know it or even have any idea it's going on. And that is when the Fed is buying and selling treasury bonds or securities. We talked about that earlier. This is their favorite tool in the monetary policy toolbox. They use it all the time. And we're going to talk about the effect it can have in a second. So if we want to contract the economy, that means we want to slow it down. It's growing too fast. We want to increase our discount rate, which will therefore influence other interest rates to go up. We want to increase the reserve ratio because it does not allow us to have as much money flowing around. The money multiplier drops. And we want to sell bonds. Why do we want to sell bonds? Because if the Fed is selling me a bond, what am I going to give them in exchange for that bond? Well, I'm going to give them cash. And if I give them my cash, it's not in the money supply anymore, and therefore it slows down the economy. On the flip side, expansionary monetary policy, we're going to do all the opposite. Decrease the discount rate because lower interest rates spur people to buy stuff. Decrease the reserve ratio because the lower the reserve ratio is, the more money banks can lend out at that lower discount rate. And we're going to want to buy bonds because if they buy bonds from me, they're going to have to give me cash. And now there's more money in the money supply. It's important to note that the effect of an open market purchase on the money supply is greater than the effect on the monetary base. And we already knew that because we already know that the money multiplier is a thing. So What do these things do? If we do contractionary monetary policy, it's going to decrease the money supply, which will increase the interest rate, decrease investment spending, and decrease our real GDP or output. However, if we're trying to expand and we do expansionary monetary policy, it will increase our money supply, decrease our interest rate, increase investment spending, and therefore increase real GDP and output. And you might be like, how am I going to remember all that? You're going to learn the graphs, and the graphs will give you all of those answers. This is just all those answers put on a nice little chart, which you could also learn. Okay, so we're going to do a practice question, and then I'm going to show you how all those graphs lead to each other. And I'm telling you right now, we're not going to finish by noon, but I will stay until we're done. A few minutes over if you guys have a few minutes extra on this lovely Sunday. Okay, so practice question number 6. Fiveableville is in a time of unprecedented expansion. Which of the following is a monetary policy action that their central bank can take to bring the economy back to full employment output? And you might be thinking, expansion, that's great. But sometimes the economy grows too fast. When it grows too fast, inflation gets crazy. And then they do want to slow down the economy. So what could the central bank of Fiveableville do to slow down their economy? Which one of those things? Can they sell bonds, buy bonds, lower the discount rate, or lower the reserve ratio? Which one of those things will slow down the economy? All right, very nice, very nice. Yes, indeed, we are going to sell bonds because when they sell those bonds to us, they are taking our money, and that is taking that money out of the money supply and slowing down our economy. So what we're going to do now is I'm going to show you this series of graphs, and they look kind of cray-cray, but it basically takes everything we looked at on that last chart and it shows it to you in graph form. Dun, dun, dun. Okay, so let's look at the first graph. We're going to take it one graph at a time if you're scared looking at the graph, all those graphs in front of you. So that first graph is an aggregate supply and aggregate demand graph, okay? And what you see there is that our aggregate demand and our short-run aggregate supply are in equilibrium to the left of our long run, which means we're in a time of recession in this graph. Okay, we are not producing our full employment output. So then the Federal Reserve Bank is like, oh my gosh, we're in a recession. We need to fix that. So they are going to implement some sort of monetary policy to expand the money supply. That is the second graph. Notice our money supply is moving to the right, so it's growing. When that money supply moves to the right, you notice the new equilibrium point has a lower interest rate. If you remember a few slides ago, we showed how changing the money supply can affect investment demand. That's what that third graph is. And of course, the lower the interest rate is, the more people are demanding. So they move along that curve from point A to point B. So when all of that happens, investment demand is going to increase aggregate demand, right? Because investment is part of C plus G plus I plus NX. So our aggregate demand curve from our very first graph is going to increase because aggregate demand is going to go up. It's going to move to the right to a new point of equilibrium, now in equilibrium with the long run, where it makes our fun star. And notice here we have a higher price level, but we're back in equilibrium, back at full employment. So that's how each thing leads to the next. Do I need to know all of these graphs? Yes, absolutely. Memorize the graphs. It will save your brain on your exam because you'll be able to just draw things out and not have to memorize charts that have no meaning. This is like when you're in math class and they ask you to just say the Pythagorean theorem, and then your other math teacher asks you to prove the Pythagorean theorem. So understanding the graphs will give you enough background knowledge that it should make it easy to answer any question, and it's not just blind memorization, so I highly suggest doing it. Okay, last thing, the loanable funds market. Oh my gosh, look, another demand curve that's downward sloping. Like we've definitely never seen one of these ever before, except all the time. But please note that the y-axis here is not interest rate. It is RIR, which means real interest rate. Okay, that's very important. And on the bottom, quantity of loanable funds. There is an inverse relationship between real interest rate and the quantity demanded of loanable funds. You can move along the curve always, but you can always move the curve. And these are the things that might cause the demand of loanable funds to move. I should probably explain what loanable funds are. It's the amount, demanding loanable funds is like demanding money to borrow. Let's put it that way. So, why might that change? Well, foreign countries might demand more money or more borrowing money. That would increase the demand for loanable funds. I might demand more money. The regular people, us Joe Schmoes, that's borrowing, lending, and credit, that will increase loanable funds. Now, if we demand less, we're like, I don't really feel like being in debt anymore. We all watch Dave Ramsey. Nobody wants a credit card. Nobody wants to buy a house with a mortgage. That's going to take the demand of loanable funds and it's going to decrease and shift it down into the left. Deficit spending, which is spending money you do not have. Deficit spending is when the government spends money they don't have, and they do that all the time. That's going to increase the demand for loanable funds. And so might expectations for the future. The government's spending like a whole bunch of money right now because we're going to have the Olympics here in LA. I don't know if you know that, in like, I don't know, maybe 2028. And so the government is like, oh, we need to build all these extra stadiums because we don't have enough already, which is absolutely incorrect. But they're going to build more stadiums. And so they need to borrow money to do so. So that would be an expectation for the future that would shift the demand for loanable funds. And one thing we're going to talk about next week, we're going to go in, not next week, Friday, we're going to talk way more about loanable funds, because we're going to talk about crowding out and things like that. So this is a quick overview right now, but we're definitely going to broach this topic again. There's also a supply of loanable funds, which shockingly enough looks like most of the supply curves we have looked at. Again, real interest rate on that y-axis, quantity of loanable funds on the x-axis. There is a positive relationship. That's why it goes up. What might shift the supply of loanable funds? The savings rate. What is the savings rate? That's how much people save. It's not an interest rate. It's like how much people are saving. Because the more they save, if I'm saving a lot of money in the bank, that gives the bank a lot more money they can lend out. Okay. Again, expectations for the future. Lending at the discount window. That's when they borrow money from the Federal Reserve Bank. And foreign purchases of domestic assets, again, when foreign countries invest or don't in our economy. We'll talk a lot more about foreign exchange and the effect of that on the economy in Unit 6. So don't stress if that doesn't quite make sense to you right now. Okay, so I think this is our last real slide. So we're only 2 minutes over. It's not so bad. It makes up for the fact that you guys couldn't hear me for like the first 3 minutes. So the loanable funds market is when you take the supply of loanable funds and demand for loanable funds and you put them together. And equilibrium is where the two lines meet. Absolutely shocking, I know. So this can show the effects of government spending, taxes, borrowing, all those things. It describes the behavior of savers and borrowers. If they charge an interest rate above equilibrium, above that real interest rate you see, then the loanable funds market will have a shortage, right? Because, interest rates above equilibrium will create a shortage in the loanable funds market. And then you will see a change in market forces. So other things will happen that will drive the interest rate back to where it is supposed to be. We will cover more of that next week or Friday for sure. If the demand of loanable funds increases, so will the interest rate. If the supply of loanable funds increases, then the interest rate will go down because that means there's more loanable funds, so they cannot charge as much money for them. Again, remember that the graph uses real interest rate instead of just interest rate. So that's super important. Okay, we survived, and you should connect with Fiveable on Twitter, Instagram, and YouTube. And you should go hang out in the Discord forum, and you should have a very lovely Sunday. A happy Easter if you celebrate. I think it might also be the last day of Passover if you celebrate. You might be finishing spring break like me, so you might not be in any sort of celebratory mood. But we have made it through our fourth of our 8 hour long CRAM session. So we're halfway there, and then one big CRAM at the end. And then we're all going to pass our AP test, which gives us all reason to celebrate. Have a great Sunday, you guys, and I will see you on Friday.